$1 billion property portfolio in residential homes and shopping centres. Retail is doing it tough, remember. Anyone invested in Stockland would sure welcome these rate cuts and tax cuts and, as we've said, APRA lifting its mortgage serviceability hurdle. There's one more hurdle for the business, though, and that's the credit squeeze. Well, I caught up with Stockland Managing Director and CEO Mark Steiner and asked him first how much difference these two rate cuts would make.
Oh, quite a lot, Ticky. It's more probably psychological to some degree, but there's no doubt the cost of money has come down somewhat, and that's going to feed into people's return expectations and their willingness to invest. It also means that parking money in the bank is less attractive, so money should be coming into the economy.
So when we see the data come through over the last few days on the Sydney market and the Melbourne market, can you see a floor in the property market residentially now?
Yes, we're pretty confident in that. So we've seen in Sydney and Melbourne where the impacts were greatest, a 40 to 50% improvement from a low base in inquiry levels. It's slowly translating into increased sales as well. So there's definitely a degree of pent-up demand, and now it's really going to come down to credit availability from here.
And you are seeing an increase in sales?
Yes.
Well, let's talk about credit availability. This week, New Housing Minister Michael Sukkar raised concerns about responsible lending in the light of the Royal Commission. What do you think of the situation with responsible lending?
Oh, look, I think his comments were spot on. At the end of the day, we've got one of the lowest levels of defaults in the world. We've had that for a long time. People do change their behaviours when they take on a mortgage. It's full recourse, and they will tighten their belts to be able to make their repayments. The last thing Australians give up on is the repayment of their home. They don't want to lose their home, so they'll repay their loan. That's what history has told us, and it's served us well. Of course, we need to be responsible in lending, but checking on an individual Uber receipt or where did this little piece of money come from, that's not going to serve anybody well. Ultimately, that's not how you really make good risk-based decisions.
So that's one area that could be freed up, I suppose. The other area is the mortgage serviceability rate. What difference could that make?
Oh, it's huge. So, going from the current 7 with an additional 25 or 50 on top, which is basis points, which has been used to, say, 6 for argument's sake. In terms of the average mortgage, a borrower's capacity, that's up around $70,000 plus. So that replaces a lot of what the tightened credit conditions have removed as it relates to documentation, household expenditure measures and all the other changes that have occurred. And that, of course, ripples across every new loan that's written. So it's a big deal. Now,
you warned investors last month, I think, of a 5% rise in home buyers defaulting on your house and land sales. So if you had to pick a factor that more than anything else was causing that, what would it be?
Credit availability. The customers are still having a lot of problems getting their loans processed. There's still a lack of consistency around documentation, albeit it's improved. And I think at the end of the day, and this is where we saw the comments that you raised around the minister's points, we need a clear playing field. We've got to be pragmatic about this. We need to recognise our lending has served us well as it relates to responsible lending, and ensure that we're able to lend people money who are in a position where they want to build a home or start a business. This has also affected small business. Small business has had credit restraint now for nearly 2 years, and a lot of small business will use the family home or a home as collateral. And so when you have this pullback, it's a circular effect, and we've seen that across the whole economy.
And you've seen that in your dealings with small business, have you?
Oh, absolutely, particularly in the shopping centres. There you've seen and had an inquiry into franchisees as well. Those things combined has dramatically reduced the number of new businesses that are being started. And so particularly when you get outside of the big cities, it's been very problematic for small business owners, particularly in retail. Tax
cuts look to be going through after all. Do you think that'll make a big difference on the retail side?
Tremendous difference. In the last 12 months, the average tax revenue grew 10%. Wages grew around 2.5%. That's unsustainable. So addressing bracket creep and putting, basically giving mums and dads back money to spend on looking after their families and planning for their future. That's good practice, and it will certainly read through into the economy quite very directly.
Let's talk about your big announcement this week, and that is around your huge project, Aura. Now, you're moving into capital partnerships, this one with Terry Snow, the rich lister who owns Canberra Airport. Now, what is the thinking behind this?
Well, it enables us to recycle some capital into other growth opportunities, both in residential communities and also in our logistics business, where we've got a $740 million pipeline, and we also have more than $1 billion of workplace development to come. So it effectively enables us to continue to deliver a great customer proposition at Aura in partnership with the Capital Property Group.
And it's a massive, I mean, I think it's $5 billion project value when it's completed.
Yeah, yep.
But equally, presumably, this is about spreading your risk, particularly because of, you know, the tougher conditions. Would that be right?
Well, it does provide a diversification benefit. I mean, I wouldn't want to leave the impression that we were concerned about our exposure to Aura. It's a great project. It's performed well through the slowdown, and it's a fantastic customer proposition as it relates to affordability, livability and connectedness. It's an exemplar project. It's won many awards and has great appeal to customers. But certainly from the point of view of sharing ownership and being able to recycle capital to grow further and scale our real estate expertise, that is part of our strategy.
Some would say that perhaps you've been a bit late coming to this idea of capital partnerships. I mean, the other big players use it quite commonly. Are you quite late in the cycle to come to this?
Well, we've always had capital partnerships, particularly in the communities business. We had a very large partnership with Waterfront Place in Brisbane historically. So we're not new to this space, but we're certainly increasing our activity and expanding what we're doing.
Stockland's obviously got a reputation as a high-end builder, but I need to ask you about some of these recent high-profile slapdash bills, peers, when you think of Opal and Mascot Towers. Now, I've also read that perhaps 80% of the build in the last 10 years could have some form of structural defect. Now, should city dwellers be worried about these sorts of numbers?
Well, I'd certainly hope that the numbers are nothing like that and that these examples are isolated. Certainly we have a good building code, and we have a good process around building approvals and development approvals.
So what went wrong?
Well, clearly in this case, without knowing all the detail, you can only imagine that some of the required compliance has not been entirely followed. So there's probably a case for even greater in construction inspections and making sure that there's compliance. We clearly stand behind our homes, and we seek to hold our builders to account to build a very high quality product. And I think out of this, hopefully what comes is more surety for customers. It's very important that the quality of homes is very high, and the quality of all buildings are high.
But you think that's, alarmist, that sort of talk of maybe 80%?
I can't imagine that would be the case. But certainly anyone that's operating and is not doing it in a credible way should be stopped. Running alongside this, of course, is the whole combustible cladding issue. Now, there seems to be a real concern about what this is doing to professional indemnity insurance, and again bringing in more red tape. Yeah, the cladding's interesting, and to be fair to each state, they look to have made some level of concessions so that we don't get a stalling. I think that's a good example where that product really shouldn't have been allowed into the country and allowed to be used. So you could argue there that we have some tightening that's required, and clearly now coming through. We've responded in a very constructive way in the limited examples where we've seen it in our assets, and we've isolated it and removed it typically.
But do you think it's going to impact the build going forward, or impact what's happening to existing buildings which are cladded out like this?
Well, they'll have to be certified as safe. There's a whole process around that, and that's going to be about where it's installed and the probability that it could contribute to a fire. And clearly, if it's in an unsafe installation, it will need to come out.
Who should end up paying for this?
It's a very complex question, Tiki. I mean, ultimately, the approach we've taken is that we funded the removal.
You, the company?
Yes.
Moving to retail sales, I mean, again, this week we've had retail sales figures below consensus, some economists even lowering GDP forecasts. So it's really challenging out there, isn't it, in the retail sector?
Well, it certainly is in different segments. The weak elements were in discretionary, fashion and shoes, and department stores. Food itself, actually, there was a little bit of deflation, but in fast casual dining and in general home goods, the growth was actually reasonably high. We've seen in our community town centres growth annualising at just under 4%, and that's quite a healthy rate. It reflects a focus on convenience and on making sure that we've curated for the customer.
And I notice you're looking at the sale of Glasshouse just outside here. Is that also looking at perhaps shifting your portfolio weightings given the times?
Well, we're looking at where we can reallocate capital, where we'll get the highest return for our shareholders and our security holders. So we're always looking to optimise the mix of allocation to optimise the return.
Back into the office sector, which seems to be quite bullish. Do you think, given the access to all this cheap money now, this could be the beginning of another bull run on property and possibly a bubble, or do you think the REIT lesson has been learned?
Well, it's been a pretty strong run, particularly in those commercial sectors, and no doubt with lower rates it means it potentially goes a bit further. The underlying fundamentals of demand and supply are still good at this point in time, and the rental growth prospects are reasonable. So we don't have, I'd argue we don't have bubble conditions at this point, but it certainly warrants continued watching. You don't want to overstimulate a sector.
Mark Steiner, wish I had more time as always. Thank you so much.
Thank you, Tiggy.